You have probably heard about Jack Bogle's 3-fund portfolio, or Warren Buffett's 2-fund portfolio, or even Ray Dalio's all-weather portfolio. The thing is, these portfolios were created over 40 years ago, and a lot of things have changed in terms of technology and the investing landscape. Now, I've researched and formulated a new updated portfolio which only requires 2 ETFs for you to maximize your return, and it's very simple to set up. So in this video, I'll go through exactly what these 2 ETFs are, what are their performances like, and how I allocate them in my portfolio. Just a quick disclaimer, this is not financial advice as I am not a financial advisor, so please do your own research. Now let's start with my new portfolio allocation. With this new portfolio, 70% will be US stocks, and this includes ETFs that tracks the S&P 500 like VGS. The other 30% will be held in gold with ETFs like GOLD. Otherwise, hold cash if you find the market to be very heated. For example, if you start seeing your auntie now being the stock expert, that's time to kind of cash out and not be in the market. Now, why this particular structure? The 70% US stock gives you the best market return from the biggest and fastest growing economy in the world with the added benefits of diversification. The 30% gold gives you safety and reliability during recessionary times, while still providing you very high returns during the bull market. Now, I will go over this later on when talking about the relevant ETFs. You might ask, why did I not include any Australian components like the VAS exchange traded fund? This is because the Australian economy is very much correlated and dependent on the US market. Therefore, the downside risk is very similar to the US, while our growth is significantly lower. For example, VAS, or the ETF that tracks the Australian Stock Exchange, has a 10-year annual return of only 8% compared to 12% of VGS, which tracks the S&P 500. You might also ask, Warren Buffett and Jack Bogle used to have bonds in their portfolio. Why are there no bonds here? Great question. Bonds have traditionally been safe assets to hold to give your portfolio great returns and lower risk. However, given the much lower yields in the last decade, this boost in return is no longer there. As a matter of fact, because of the lower yields, the government had to increase bond yields quite significantly in the last few years. This made the bond market crash severely. For example, in 2022, when the S&P 500 dropped 18%, the bond market, rather than hedging, it fell by 13%. That's why now I hold cash in high savings account for liquidity purposes. Moreover, if you do notice, I have no international stocks. The point of investing internationally is to get that emerging market high return potential in exchange for higher risk like China, Indonesia, and India. As I mentioned before in my other videos, according to the 18.6-year cycle, this last 2 years of 2025 and 2026 should see big gains in the emerging market. However, I see these as short-term gains with high unpredictability. Additionally, international ETFs like VXUS have underperformed severely, with only 5% average return in the last 10 years. Also, a lot of companies in the S&P 500 already have international exposures, like Apple and Google, who sell products globally. So I do believe they are already giving me the best exposure with minimal risk. Let's move on to the second point. What are the 2 ETFs, or exchange traded funds? For those who don't know, an ETF is a fund that you can buy and sell from the stock market that replicates the performance of a market index like the S&P 500. People usually buy ETFs because it allows them to invest in many companies just under one stock ticker. Even Warren Buffett himself recommends 90% of people to invest into ETFs rather than picking individual stocks, because historically, 90% of all fund managers are not able to outperform the market in the long term. Now, what are the 2 ETFs I mentioned before? They are VGS and gold. VGS allows you to invest into the top 1,500 companies from developed countries like US, Japan, UK, Canada, and France. This includes the biggest and fastest growing companies in the world like Apple, Google, Microsoft, and Toyota. While this is an international ETF, because of the US big market cap and high growth and performance, it makes up 72% of this fund, followed by Japan at 6%. The 10-year average return for VGS is 12%, and the 5-year average is 14%, with the 1 year being 13%. The second ETF I want to talk about is gold. Now, gold is an ETF that allows you to invest into physical gold instead of actually going to a store and buying a gold bar and holding it yourself, which can easily be stolen and cost more to hold. As I mentioned before, holding gold is a great option during an inflationary bull market like we have today, and a great one to have during a recession as well, since people tend to run to commodities and gold in times where trust in the government declines and is very, very low, which is very similar to today as well. However, do be mindful that this is only true in an inflationary recession. It's a different ballgame for deflations. Regarding performances, the 10-year average return for gold is 12.40%, and the 5-year average is 13.7%, 3-year being 25%, and the 1 year being 45%. Lastly, let's go through which broker I actually recommend. I currently use Stake because of its low cost and access to both US market and Australian market. Also, it's extremely easy to use and have a great support team. I personally have not been able to find a better alternative. Well, there you have it. Do let me know what you think about this issue in the comment section down below, and if you want to see more like this, follow along.